Welcome to vTalkInsight Allocator's Lens Daily for February 23rd, 2026. Cross-asset positioning is being pulled in different directions today, with U.S. inflation running hotter, growth data cooling, geopolitical risk lifting oil, and volatility indicators flashing amber, even as headline equity indices hold up. Let's start with equities, where strong earnings and AI spending are now colliding with these macro and geopolitical crosscurrents. In equities, the dominant story is resilience on the earnings side, meeting rising macro and geopolitical tension. U.S. corporates have now delivered 6 consecutive quarters of profit growth, with megacap technology names still expected to grow earnings above 20% and broader indices, targeting double-digit gains. On top of that, hyperscale technology platforms are projected to lift AI infrastructure spending to around $600 billion this year, a huge step up that underpins revenue visibility for semiconductors, hardware, and key material suppliers. That earnings and capex backdrop is driving a powerful, but messy, rotation within equity markets. Capital is moving away from software and some richly valued growth names toward hardware, semiconductors, and industrials that monetize AI demand more directly. Flows into international and emerging market equities have accelerated to their fastest pace in about 5 years, helped by Asian semiconductor exporters, Latin American commodity stories, and themes like defense, spending, and gradual de-dollarization. Europe adds another layer of nuance, with luxury and travel names posting robust results and premium demand, while basic resources and parts of French industry still look sluggish. Airlines and hotel groups exposed to high-end travel are seeing strong premium traffic and pricing power, and luxury brands such as Moncler and LVMH have rallied on better-than-expected revenues, particularly linked to China. By contrast, small caps and more cyclical segments, especially those tied to domestic U.S. demand or reliant on private credit, continue to lag, signaling caution around the breadth of the macro recovery. Under the index level, risk feels less tranquil than headline moves suggest. The volatility index has spent time above 20 recently, even as the S&P 500 has only drifted modestly, and single stock swings, especially in software and AI-disrupted sectors, have been severe. At the same time, gold volatility is at its highest since the global financial crisis, while Nasdaq volatility remains relatively subdued, raising the risk that turbulence in safe haven assets eventually spills over into growth equities. Against that backdrop, upcoming earnings from large AI beneficiaries, particularly NVIDIA and the hyperscalers they supply, look like a key test of whether the AI-led capex cycle can keep carrying equity leadership or whether macro worries start to dominate. Turning to rates, the latest U.S. data have sharpened the dilemma for central banks and fixed income allocators. Core personal consumption expenditures inflation for December rose 0.4% month-on-month, with a year-on-year rate at 3%, hotter than expected and still clearly above the Federal Reserve's 2% goal. At the same time, fourth-quarter GDP slowed sharply to 1.4%, roughly half the prior quarter's pace, signaling that economic momentum is cooling even as price pressures prove sticky. Fed communication reflects this tension. Recent minutes suggest most policymakers prefer to sit tight and tolerate somewhat above-target inflation for now, although a few officials remain open to further hikes. Market expectations, however, still lean toward roughly 3 rate cuts this year, drawing comfort from ongoing disinflation in housing, some softness in activity data, and a view that recent goods and labor strength will not derail an eventual easing cycle. In practice, front-end Treasury yields have edged higher on hawkish remarks, while overall yields remain not far from recent lows, hinting that bond markets are pricing a softer growth path or a relatively gentle policy stance. The long end of the curve faces its own pressures. Heavy Treasury issuance, potential fiscal strain from tariff refund rulings, and stronger global competition for capital are all seen as forces that could push term premiums higher over time, with some expecting the 10-year yield to trend towards 6% over the next couple of years. Layer on a renewed oil shock from Middle East tensions, and the risk of a stagflation narrative re-emerging is clear, which could delay or limit the scope of future Fed cuts, even if growth disappoints. For now, the key watch points are upcoming inflation releases, the path of energy prices, Treasury supply signals, and any shift in Fed rhetoric around how much above target inflation they are willing to live with. Credit markets look relatively calm on the surface, but private credit is emerging as a focal point for hidden stress. The roughly $1.8 trillion private credit universe is grappling with a surge in redemption requests at retail-focused vehicles, with some funds reporting a doubling of withdrawal demands in the latest quarter. In response, structures have been tightened, redemptions curtailed, and in one prominent case, a business development company has been wound down in a way that rattled confidence and hit the share prices of several listed private capital managers. The interesting nuance is that underlying loan performance still appears robust in many portfolios, even as fund-level liquidity is challenged. Blue Owl, for instance, sold about $1.4 billion of loans across more than 100 companies at close to par value to meet redemptions, signaling solid demand from institutional buyers and supporting current valuations. At the same time, large banks like Bank of America are committing fresh capital to private credit deals, intensifying competition and suggesting that for now credit risk is perceived as manageable, while liquidity risk is the true fault line. The bigger question for allocators is whether strains in private credit become a macro transmission mechanism. Tighter funding conditions for middle market and smaller companies, particularly in technology and AI infrastructure, where one high-profile data center financing recently fell through, could weigh on investment and employment even if large public issuers remain well-financed. Regulators are increasingly focused on opacity, leverage, and the growing links between private credit funds and insurance balance sheets, raising the likelihood of heightened scrutiny and potential rule changes. Monitoring redemption trends, any further gating headlines, and pricing on business development companies and leveraged loans will be critical for gauging whether today's liquidity squeeze stabilizes or spills over into broader credit spreads and equity risk premia. In foreign exchange, the U.S. dollar has quietly reasserted its safe haven role. It has been the top-performing major currency over the past week, with Eurodollar drifting lower as investors seek protection ahead of key U.S. data and in response to rising geopolitical tension around Iran. This dollar bid is echoed in safe haven flows into gold, and it functions as an additional tightening of global financial conditions, particularly for emerging markets and dollar borrowers. Looking a bit further out, the picture is less one way. Expectations for an eventual Federal Reserve cutting cycle and a U.S. administration that favors a more competitive currency point toward renewed medium-term downward pressure on the dollar, even though recent euro strength has stalled and the currency pair has traded in a range since mid-2023. Japan is a potential swing factor. Structural reforms and efforts to shift household assets from cash into equities, combined with the prospect of faster Bank of Japan rate hikes after spring wage negotiations, support the case for a stronger yen over time. How those dollar and yen narratives evolve will matter not just for FX positions themselves, but also for flows into Japanese assets, hedging decisions, and the broader appeal of international equities versus U.S. benchmarks. Commodities are where geopolitics and macro risk collide most visibly right now. Brent crude is trading around a 6-month high, with estimates of a $3 to $10 per barrel risk premium linked to escalating U.S.-Iran tensions and fears over key transit routes such as the Strait of Hormuz. Scenario analysis suggests that a severe disruption or closure of major choke points could send prices toward $100 or even above $110, particularly given limited spare capacity at OPEC+, where Saudi Arabia's roughly 2 million barrels per day buffer may not fully offset a large Iranian outage. Those energy price risks feed directly back into the inflation and rate story, potentially complicating the Fed's easing plans and weighing on energy importing equity markets if they materialize. Precious metals tell a slightly different but related story. Gold has surged above $5,000 an ounce, and silver has jumped about 7% in a single session, underscoring intense demand for safe haven assets amid policy uncertainty and geopolitical risk. However, gold now looks expensive relative to crude oil and is trading with volatility at its highest level since 2009, while some gold miners are guiding to lower production and seeing their shares fall despite decent earnings. If Middle East tensions ease, that combination of rich valuations and elevated volatility could leave precious metals vulnerable, and any sharp reversal would be another potential source of cross-asset volatility, given how widely gold is being used as a hedge. Stepping back, the cross-asset picture today is one of a still intact earnings and soft landing narrative being tested by sticky inflation, higher oil, a firmer dollar, and growing scrutiny of private credit liquidity. Equities continue to lean on strong cash flows, AI-driven capex, and robust luxury and travel demand, but leadership is rotating and volatility beneath the index level is rising. Rates are caught between hotter core PCE and slower growth, with markets still pricing a moderate Fed easing path even as higher for longer risks build, especially if energy prices spike again. Credit remains well bid at the top of the quality spectrum, yet retail-oriented private credit vehicles are revealing important liquidity mismatches that could become a transmission channel to the real economy, if not contained. In FX and commodities, a stronger dollar, a potentially more assertive Bank of Japan, and an elevated oil and gold complex mean that geopolitics and policy divergence will stay central to cross-asset allocation decisions. From here, key signposts include upcoming U.S. inflation data, central bank communication, private credit redemption trends, the next leg in AI-related earnings, and the trajectory of oil and gold prices. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.